Right now, somewhere in America, a tow truck is idling outside a house that isn't its own. By tonight, it'll have company. In 2024, roughly 1.73 million vehicles were repossessed in this country, the most since 2009. And the trend wasn't slowing down. Watch that number for a second. It doesn't stop. Not because people got lazy, because the typical new car payment is now about $763 a month, and Americans, across every kind of auto loan, now owe $1.67 trillion just to keep their cars on the road. So here's the question worth asking. Not whether your car loan alone can take down the economy, but whether America's car debt problem could become part of the next one. Let's rewind to how we all ended up here. A few years back, car prices started climbing. Interest rates started climbing, and somehow monthly payments climbed too. Something wasn't adding up. So the industry did what the industry always does. It didn't lower the price, it stretched the loan. 3-year auto loans became 5-year loans. 5 became something even longer. If the number's too big to pay off quickly, you just don't pay it off quickly. Problem solved. Sort of. Picture the finance office at a dealership. You just want a car that starts in the morning. The finance guy slides a paper across the desk. Great news. We got your payment right where everybody's is these days. You don't ask how. You just sign. Because a monthly number always feels smaller than the total ever will. Multiply that by tens of millions of Americans, and you get a country where long, stretched-out loans aren't the exception anymore. They're the plan. And here's the part almost nobody explains right. A large share of auto lending doesn't stay on the original lender's books. Loans get bundled together and sold off to investors through something called securitization, which is where things get interesting. Many auto lenders don't keep the loans they originate. They bundle thousands together and sell them to investors, pension funds, insurance companies, hedge funds. That's securitization. Basically, a very expensive game of hot potato where the potato is $1.67 trillion of Americans' car payments. By 2019, most new car loans in America weren't even coming from a bank. They were coming from someone else entirely, the car brand's own lender, a credit union, a subprime specialist. Which means when people say the banks are at risk here, they're not even talking about the bank that gave you your loan. The whole system depends on one thing: trust. Lenders trust the collateral behind the loans. The actual cars is real. Investors trust the lenders. Then came Tricolor Holdings, a major subprime used car dealer and lender. Federal prosecutors allege its founder ran a fraud scheme for 7 years straight, pledging the same car loans as collateral to multiple lenders at once, allegedly involving roughly $800 million in double-pledged collateral. Some of the loans behind that collateral, prosecutors allege, didn't even exist, fabricated, on paper only. When it unraveled, Tricolor collapsed into bankruptcy almost overnight. JP Morgan, one of the largest banks on earth, had to eat a charge of roughly $170 million just from this one lender. JP Morgan's own CEO didn't sugarcoat it. When you see one cockroach, he said, there are probably more. Here's the actual lesson, though. One fraudulent lender, operating in a corner of the auto finance world most people have never heard of, still managed to create losses big enough to reach one of the largest banks on earth. That's the real warning. An apparently niche auto finance problem can spread through the financial system in ways nobody sees coming until it already has. And that's just one bad actor doing something illegal. Here's what happens when the system works exactly like it's supposed to, and loans still go bad. No fraud required. First, repossession. Then the car typically gets sold at auction, often for less than what's owed. The gap between what you owed and what the car actually sold for doesn't just disappear. That's called a deficiency balance. It doesn't happen every single time, but it happens often enough that lenders price the risk in before they ever hand you the keys. When enough of that happens at once, some of those families don't just quietly absorb it. They fall behind elsewhere too. It doesn't happen to everyone, but often enough, a car loan problem doesn't stay a car loan problem. It just changes its name to a credit card statement. It doesn't stop at the household either. The American auto industry, factories, dealerships, parts suppliers, lenders, is enormous. It's a huge slice of private sector jobs in this country, and a meaningful chunk of the entire U.S. economy. And for a lot of families, a car isn't a luxury to trim. It's the only way to get to work. Economist Brett House put it simply: Americans put their highest priority on auto payments, ahead of credit cards, sometimes ahead of rent. Because if the car goes, the job might go with it. So here's the real question. All of that, the stretched loans, the securitization, the fraud, the repos, the ripple into paychecks and factory floors, adds up to $1.67 trillion. Is that actually enough to break something the size of the U.S. economy? $1.67 trillion sounds like the end of the world, until you put it next to the monster that actually broke the economy in 2008. Mortgages. Stack today's entire pile of auto debt next to that, and it barely reaches its knees. Picture a banker running the actual worst case on the back of a napkin. Even in the ugliest version of this, it comes out to about $334 billion in losses. Real money. Painful money. But in 2008, banks didn't lose hundreds of billions. They lost trillions on mortgages alone. This isn't that fight. Not yet. And here's the twist inside the twist. It's not really Americans who are in trouble here. It's a specific kind of American. Picture two neighbors on the same street, both a few car payments deep. One has shaky credit, a subprime loan, and missed payments piling up worse than almost any point since before the last crash. The other has decent credit, hasn't missed a single payment, and has no idea anyone thinks there's a crisis at all. Same debt, same street. Wildly different Tuesday. Banks know exactly which neighbor to worry about. They've spent the last few years quietly stacking cash in reserve and tightening who gets approved, building the kind of cushion they didn't have walking into 2008. Regulators have already run the nightmare scenario on paper, a severe downturn on purpose, just to see what breaks. The banks stayed standing. Even the headlines can't agree on how scared to be. Same $1.67 trillion pile, two totally different stories, depending on who's holding the calculator. And underneath it all, most Americans still have a job. As long as the paycheck keeps showing up, people find a way. Refinance, skip a vacation, grit through a rough month. Most of the smart money is still betting on limping through this, not falling off a cliff. So, okay, auto debt is a real problem, but by itself, it's probably not the recession, which leaves one real question left. If $1.67 trillion isn't big enough on its own, what would actually have to happen for it to matter? Picture dominoes lined up on a table. Defaults rise. Lenders, staring at losses, get spooked and slam the brakes. Not just on car loans, on everything. Mortgages get harder to approve, business loans too. Suddenly, it's not just the guy with the subprime auto loan who can't borrow. It's your neighbor trying to refinance, a small business trying to make payroll. Spending drops, factories slow down, layoffs tick up. Paychecks shrink for exactly the families already stretched thinnest. And some of them start missing payments too, which knocks the first domino down all over again. Economists have a word for that, a feedback loop. Not a guarantee, one possibility, and every domino in that line actually has to fall for it to spin up for real. But once it starts turning, it's the kind of wheel that feeds itself. When a slowdown like that spreads far enough into jobs, incomes, production, and spending all at once, the economy can tip into a recession. The mechanism rhymes with 2008. Bad loans, tighter credit, weaker spending, job losses. But 2008 started with something much bigger: housing. Auto lending didn't cause that crash. It just caught fire on the way down. Captive lenders like GMAC and Chrysler Financial came close to collapsing entirely, and car sales cratered right along with them.
that wasn't even the main event. It was collateral damage.
Which raises the real question this time. If auto lending nearly broke on the sidelines of someone else's crisis, what happens if it's not on the sidelines this time? Here's where this actually lands. Auto loans probably aren't big enough to sink the economy on their own, but if a downturn starts somewhere else, rates, jobs, something nobody's even watching yet, all these stretched thin car payments won't just sit there quietly. They'll make it worse. And they'll probably be one of the first cracks anyone actually sees. Because the real question isn't whether Americans can keep paying for their cars. It's what happens when the people already stretched this thin lose the thing paying for everything else, their paycheck. The auto market probably isn't the coal mine. It might just be the canary, telling us something else is wrong. For now. Because somewhere out there right now, another tow truck just found another car. And the only real question left is whether this canary is singing alone, or whether it's the first sign of something bigger than cars.